Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for April 6, 2013. We have a market that's in bullish normal conditions. On an annual basis, using weekly RSI 14, it's come back to the high end of neutral at 70. On a 10-day basis, using the 10-day NDX, it's at 40 out of 100, so the lower end of neutral. Percent stretch relative to the 200-day moving average is 8.57%, so white bullish. And the slope of the 50-day moving average has started to flatten out to 0.49%, also white bullish. ADX 14, the measure of trendiness in the market, is at 17.4, getting to the point where near 15 it would be completely sideways and untrending. ATR percentage is creeping up to 0.97%, mid-range of normal. The risk index, which is the 30-period moving average of the VIX divided by the 10, is at 1.01, so right on the boundary of risk on and risk off, slightly leaning towards risk on, but that's gotten weaker in the last week. If you take the Z-score of that 1.01 compared to the last 5,000 days, we have a Z-score of 0.08, and you can see the time series of the last 30 days here. And that's really the boundary between risk on and risk off. Blended monthly rebalancing continues to hold mid-caps, Japan, and financials with the 26 ETF portfolio. With the 13 ETF portfolio, it's mid-caps, Japan, and U.S. small caps. Next reevaluation is honored about 1 May. ETF 2, the theoretical model is at 70% for exposure. The model portfolio itself is at 100% exposed, and we're updating the number of stops this week. You can sign up for new trading videos in the trades of the week at that YouTube channel, Kennifer8. Two of the 13 ETFs are on a cash signal here in the blended monthly rebalancing. Again, you can see the three current leaders, Japan, mid-caps, and the diamonds. In the 26 ETF portfolio, about half of them are on cash. Most of these cash positions here are the internationals and commodity-based ETFs, and we have Japan, financials, and mid-caps currently in the top three. Looking at the 10 regions of the ETF2 model, you can see that 7 out of 10 are on cash positions. That leads us to the theoretical exposure of 70% invested, 30% cash as a guide. Last week it was 80-20, so market got just a little bit weaker this week. So that's emerging markets. Europe and Latin America are below their 4-month moving average. The S&P is better than the globals right now as measured by EFA. You can see 63 is better than 61 in terms of the strength column. Inside the U.S., it's mid caps, then small caps, then large caps. And then technology. Notice that the large caps have been catching up now to the small caps in terms of risk on. The two strongest sectors remain mid caps and small caps, and the two weakest sectors, Latin America and emerging markets. Expanding now to the rest of the world market model, see all of the U.S. is above average with the exception of the large cap tech. Mid-cap value is exceptionally strong at 66, otherwise the U.S. is above average. Japan leading the way. Asia less Japan still strong, but with clear leaders among Thailand, Philippines, Indonesia, and Vietnam, and then the laggards among the usual suspects. Australia and Singapore continue to do well. Europe is starting to fall to below average in the terms of the individual countries. The indexes themselves doing fairly well. EFA, which is that blend of Euro-Asia, is below average. Among the alternate asset classes, the private equity continues to be strong. U.S. real estate and treasuries are fine. Corporate bonds lagging. Gold and silver really lagging. Latin American emerging markets all below average except for Mexico. Comparing the business sectors, U.S. versus globals, you can see a tie in materials. Energy favors the U.S., as do financials, industrials, technology, really everything, staples, utilities, healthcare, and discretion. The three Defensive sectors in the U.S., staples, utilities, and healthcare are all dominating, and dominating globally too. So I take that to be a modified form of risk on, which favors the U.S. at the expense of the world, but then takes a look at the large cap defensive sectors for mature companies that are making money in these uncertain times. That's a continuation of the trends we've seen emerging over the last 5 or 6 weeks too. Top ETFs based on the relative strength column: Japan, staples, natural gas; Philippines, Japan, Vietnam, healthcare; insurance, the master limited partnership, that's the energy MLPs. I want to take a look at comparing now the strength to the consistency. That the consistency column is the 10-week average of strength, and then indexed again between 0 and 100. So if we see green in the strength column but white in the consistency column, that's evidence of emerging strength. So natural gas is making a nice strong run here, being green on strength and yellow on consistency. So that's a sudden surge. You can see Japan and healthcare are still early in their outperformance, since they're green on strength and white on consistency. And that's how I interpret these things. Now, those where it's green across the board, they are starting to lag a little bit. So like the financials and timber and mid-cap value. Still, anything on this list is buyable, but in terms of trying to get in front of the momentum, I like to look for green and then white in consistency. That's a little bit of an earlier read. Taking a look at the Dow 30 in the same lens. We now have a couple, Caterpillar and Alcoa, that have moved back into the red. For the longest while, all of the Dow companies have been at least yellow or better. You can see Hewlett-Packard, which did give up a couple bucks last week and may have cracked, still remains in the top position in both terms of strength and consistency. But again, I think the easy money on that one is over, and so we'll adjust our expectations accordingly. Emerging leaders then would be those that are green in strength and white in consistency: Johnson & Johnson, United Health, Procter & Gamble, Pfizer, McDonald's. Are you hearing the staples and defensive plays of mature companies that are moving to the top? And then Home Depot, Verizon, American Express, and Disney, all the key leaders. Those that are failing are down here in the yellows and the whites: Cisco, ExxonMobil, Intel, Caterpillar, and Alcoa. So some clear differentiation among the different business sectors is apparent. ETF liquidity just gives an insight into daily dollar volume, the average daily dollar volume the last 30 days, and then where their relative volatility on an intraday basis stacks up. So you still got the VIX and the gold miners being extremely volatile, high yield bonds and corporate grade bonds being extremely low volatility, obviously. We'll shift over now to the daily report. Won't read across the top again. You can see the time series of the 10-day NDX and how we've moved away from overbought in this pullback of the last week. Channeling or overreaction signals in Asia, less Japan, and emerging markets. You can see the increase in volatility starting to creep up, the decline in the trendiness as ADX has gone below 20, and now with the bears in charge. So a potential intermediate term pivot being established here as the market weakens. It hasn't failed yet, but there's definite increasing signs of weakness across the board. 10-day max pains: Hewlett-Packard, Bank of America, Intel, Caterpillar, Alcoa. So there's an opportunity to buy the leader on a dip. But again, for me, that's going to be a tactical trade, because I believe the easy money has already been made in the doubling that target gave us in the last 6 months. Channeling and overreaction signals: Hewlett-Packard, American Express, Coke, Chevron, and American Express. Again, overreactions in XLK, the spider for technology. Emerging markets, Asia less Japan. 5 DDs in U.S. small caps, blended commodities, and oil, and an ExxonMobil. Triple screen in Hewlett-Packard. A ton of 551Ws and that's created by the fact that the market itself has been up for the last 5 weeks, down compared to 5 days ago, but then turned in a white candle on Friday, and so we use that framework to look for second day momentum. In the auto framer, these are those symbols that have a 2-to-1 reward to risk ratio, not based on a pattern, but simply based on trade location, placing yesterday within the 10-day look back context. Hewlett Packard, Cliffs Natural Resources, Blended Commodities, Silver, Oil, Intel, Chevron, Coal, and Agriculture. You can see a couple dojis, the channeling and overreaction signals. The max pain range compression candidates, Hewlett Packard, Bank of America, Intel, General Electric, and Chevron. We have 3 symbols that are at 10 RSI or below, and so we'd like to notice that. IBM, ExxonMobil, and United Health all closed weekly over the last couple days. 4.8 to 1 reward to risk ratio for Hewlett Packard. I mean, that's a chance to buy strength leader on sale with a really nice reward to risk ratio if there's some follow through. So we'll check to see if there's another generation of Hewlett Packard buy on dip believers that will help push this back to new heights, but there's $1.50 available on the upside just to test the recent swing high. So that one's going to be on our short list. Intel, number 3 on max pain range compression with a 3-to-1 reward to risk ratio. Bank of America 2.4, Chevron 2.7 to 1. So some interesting possibilities in the Dow. Among the ETFs, a ton of symbols that test out better than 2-to-1 on the auto framer. Silver is of interest. It was a big day up Friday, and it's number 1 on max pain range compression, 3.3 to 1 on the auto framer. Gives some opportunities to buy recoveries in silver. We have coal, the VIX, mixed commodities, and the materials S&P rounding out the top 5 on the max pain range compression. Plenty of 551Ws to choose from. Taking a look at the RSI2 for like a 2-day washout. Mixed commodities and oil, technology and emerging markets at 7 and 4 respectively. And then Asia less Japan should be of interest. That's an 8 on an RSI2. It's at 2.3 to 1 reward to risk ratio and is an overreaction signal target. So many things to recommend our attention to Asia less Japan. Looking at the market mosaic here, the 30-period regression line, you can see that the upward slope has started to roll over. In fact, it's crossed its own 10-period moving average, which is sort of the end of one story and the potential beginning of another. We've had 3 days of increasing weakness. Although the last 2 days have been white candles, they've been giving up ground here to what had been a strong upward move. You can see that the percent stretch rolled over at 2 standard deviations above the 6-month average. It's now come back to +1 standard deviation. This still represents about a 3% pullback to get to the 6-month average. So the weakness here does have some downside potential targets for the swing trader. Looking at the Z-scores, you can see most of the indices in the large caps are showing weakness, with the exception of Japan, which is stubborn. The VIX has been showing some increasing strength here and now is in the white on Z-scores. Microsoft and XLP continue to buck the downward trend and are worthy of attention. Z-scores of the regression line slopes, you can see how they've started to roll over again now at the top of the channel. And the downside argument is supported by the fact that, there's a price pullback all the way to 150 is still within the bounds of normal for this upward move. And you can see 2 previous cases in this long move from 135 to 155 that 2 times previously the pullbacks from outside the river came down and found support at the bottom of the river. That would bring this price back to about 150, would still be consistent with the bull, and would be seen as a buy on dip opportunity all the way to that point by longer term holders. So this little pullback has just started to scratch the surface of what a retracement might be. You can see the 10-period regression line slope is now slightly below average of the last 180 days. The 30 has rolled over right at the 1.0 boundary. So again, when we see that kind of information, that tells us that the truth is changing. And now you can see that the 90 has really started to roll over. A natural rhythm for this would bring price back to the bottom of the river, and so we're not entitled to be surprised by that. But it should remind you to respect your stops and consider your profit preservation stops to lock in pieces of this nice move. I'll just scan through these reference charts quickly. You can stop them and study them if these are ones that you're using. These are things that I use as reference points to help me frame the dimensions of different trades and different time frames on the swing trade basis. I'll just have you notice here that Japan, Consumer Discretionary, McDonald's, Merck, and American Express, these are all exceptionally strong on signal to noise, which means that their intraday moves tend to be more directional than those that are at the bottom of the list. That means that the real bodies of their candles are large, and the intraday moves are more directional intraday than those that are at the bottom, where there's more choppiness intraday. That's how you read that. Can see some recovery coming back into the Dow here, as I would consider that to be a flight to quality, as some of the weakness this week has pulled back the risk on trades in mid caps and small caps and technology, and good old comfortable Dow is still moving along smartly here. You can see that the commodity-based symbols have come back from their nice run up right back to parity with the market. And some evidence of recovery in the internationals, and then particularly this nice move in Japan. You can see that's almost a 3 standard deviation move with respect to the S&P already. And so, while I respect the fact that Japan is leading the way right now, I also know that it's already put in a 3 standard deviation move. So I'm not going to be a true believer forever on that, but I will respect that it's out front right now, and we'll be protecting against the downside there. And flashing for the other charts for you to consider for reference. And that's the executive summary of the weekend reports from Tortoise Capital. We'll see you online and on the weekend webinar.